Thanks, Kristen. Yeah, so with the Federal Reserve recently implementing a 50 basis point rate cut, the fixed income markets are experiencing notable shifts in demand, pricing, and investor behavior. So we're going to dive into these changes and their impact on the broader financial landscape and how ICE's fixed income products and services are navigating these evolving market conditions with Chris Edmonds, the president of Fixed Income and Data Services. Good morning, Chris.
Good morning. Thanks for having me.
Now, I said it right there in the lead. Let's talk about how the recent 50 basis point rate cut by the Fed will impact the fixed income market in the broader sense.
Well, it's going to be about portfolio adjustment at the end of the day. If we look back prior to the announcement of 50 basis points, there was a huge consensus, is it 25, is it going to be 50? About half the market had positioned their portfolios for 25, another half the market was positioned for 50, and so now they're having to react to what that means. That's a little bit of time, that's what we've seen in the increased activity of late. But now they're all trying to position that what's going to happen next. It's always a forward-looking opportunity. So is it next going to be, there's a conversation about being 50, is it going to be 50, 25, is it going to be 225s, and where does that go? I think there's general consensus in the market that we probably end 200 basis points lower at the end of 2025. The question is, how do we get to that 200 basis points? And that's creating a little bit of the volatility in the market as a whole. Obviously, that's in the treasury market, and treasury bonds that are sitting that way, but the corporate and the muni bond sector also are reacting to that because they have to make sure they maintain the spreads accordingly.
Would you say that there are any specific asset classes or durations that are experiencing more pronounced, effects from this?
Well, I look at it from the standpoint of the answer, your short answer is yes, but it's those who have a shorter duration because that's where the reaction is. Like the long end of the curve hasn't really reacted at the same level. That's why you're seeing some of the mortgage rates still not coming down. There's reports out this morning around mortgage opportunities there haven't really seen the uptick. They're up, but they're not up at the same velocity at which people thought would come at a 50 basis point move. So longer end of the curve assets or longer end of the curve duration assets, they're staying where they are. Shorter end's reacting to the move that the Fed made.
Are there any notable behaviors that are emerging with investors as a result of this?
I still think we see some in the commercial real estate market because there's uncertainty still around that part of the economy, how quickly it's going to recover. I think the rates that we're seeing in the commercial real estate market, while they have improved some, you still have a lot of inventory out there. You still have folks who are not coming back to the office at the same pace that they once were. So you're seeing that impact the demand side for big, large-scale commercial activities in certain pockets around the country. But that is, people are cherry picking around those opportunities that they see.
And we know that higher interest rates tend to benefit savers, right?
Right.
While lower rates, favor borrowers. Talk to me about this dynamic and how you anticipate that this will impact the broader market in the near term.
Well, it's really back to a supply and demand function, right? Yes, certainly we want to help the borrowers, but at the moment in time when we need to spur economic activity, and this whole idea about the soft landing is trying to create that balance between we want to reward those who have been, not good with their money and the good stewards of their money, and at the same time we want to spur that economic investment for future growth. And so that's the balance that keeps going on out there, and I think we're going to see more of that. Some days you're doing really well. For a very long time we had very low interest rates. It was penalty for those who and that's why we sought yield in other asset classes, whether it be in equities or things of that nature. Came back in the last couple of years, you've seen that elevated interest rate, and people have shifted back to cash and holding more of that. So now that we see that balance is going to be important for people to maintain, and that'll be supply and demand of the instruments. And one last thing I would add to that is you also can't underestimate the amount of issuance that governments around the world are going to have to do in order to meet their economic growth. So there's going to be a lot of supply coming on the market for government and agency bonds.
Now, quickly, can you elaborate more on how ICE's fixed income services play a role in all of this when it comes to navigating the complexities and the challenges that come to an ever-changing market landscape?
Yeah, our ICE Bonds platform is a great retail platform that serves the individual investor community incredibly well around the country. We have our CDS business that clears both sovereign debt as well as corporate bond and other insurance on bonds that are out there. So both of those are performing very well for us at the moment. But those are two ways you can express those views. And then most importantly, we have the data business that we look after, and that data business is about the valuation. So when people are making those decisions and expressing those views at the end of the day, they have a way to make sure that they're accounting for that appropriately and holding themselves accountable to whether or not that is the right risk metric or not for their portfolio at any given time. So 3 elements of that, all mission critical along the way.
Amazing. Well, thank you. A lot of key takeaways there. Thank you for joining me, Chris.
Thank you.